Brad Williams, Frugal Finance, Understanding Financial Markets. Before selecting investments that align with your financial goals and profile, it's essential to grasp several fundamental financial concepts. These include understanding investment returns, risks, and portfolio structure. Concept 1, investment returns. Investment returns are the gains you make from your investments, either through income, capital appreciation, or both. The total return combines these two elements. For example, if you buy a stock for $100 and it pays $5 in dividends after 1 year, the income return is 5%. 5 divided by 100. If the stock's value also increases by $7, bringing its price to $107, the growth rate is 7%. Together, the total return on the investment is 12%. It's important to note that some of these returns may be taxable, which reduces the amount you keep after taxes, known as the after-tax return. Depending on your tax bracket, some returns may be taxed at a lower rate, such as long-term capital gains and qualifying dividends, which could be taxed at a federal rate of 5% to 15% depending on your bracket. If you sell an asset at a loss, you can offset those losses against gains from other sales. If your losses exceed your gains, you can deduct up to $3,000, $1,500 for married individuals filing separately, from your taxable income. To compare investments that are taxed differently, you can calculate the after-tax return using this formula. After-tax return is equal to taxable return times 1 minus the tax rate plus non-taxable income. For instance, if you compare a U.S. Treasury bond with a 7% yield to a municipal bond paying 5%, understanding the tax implications can help you choose the more beneficial option depending on your tax situation. Investment risk. Investment returns are closely tied to risk. Each investment type offers varying levels of return and risk. Risk in this context refers to the uncertainty regarding return on an investment. An investment is considered risky if there is a significant chance that it will not yield the expected return, and it could even result in a loss of principal. There's no such thing as a completely risk-free investment. Even so-called riskless investments are subject to inflation, which can erode the real return on an investment. Thus, understanding and managing risk is crucial in making sound investment decisions. Risk is typically quantified through the volatility of returns, measured using the standard deviation of returns. Higher standard deviation indicates greater variability in returns, making the asset riskier. Over a longer investment horizon, returns tend to stabilize and the volatility of an asset generally decreases. Types of risk. Cash investment, the main risk here is purchasing power risk, where inflation reduces the real value of your returns. Bonds, the risks associated with bonds include interest rate risk, the risk that interest rates will rise, reducing the value of your bond, and default risk, the risk that the bond issuer might not be able to pay back the principal. Stocks, investing in stocks carries market risk, which refers to risk of a company's stock price being affected by factors such as economic conditions or overall market performance. Additionally, a stock's beta, a measure of its price volatility relative to the market, helps assess its market risk. A beta greater than 1 means the stock is more volatile than the market, while a beta less than 1 means it's less volatile. Concept 3, portfolio structure. The principle of not putting all your eggs in one basket is key to managing portfolio risk. By diversifying your investments across various asset classes, you can reduce the overall risk of your portfolio. This diversification is based on the idea that some assets tend to perform well when others perform poorly, helping to balance out the risk. Asset allocation. A diversified portfolio contains a mix of assets such as stocks, bonds, real estate, and commodities. The appropriate asset allocation depends on your financial goals, risk tolerance, and time horizon. The goal is to achieve the highest expected return for a given level of risk. For example, adding international stocks to a domestic portfolio can lower overall risk while potentially increasing returns, as international stocks often behave differently from U.S. securities. Diversifying across different asset classes like cash, bonds, and stocks helps managing risk. The more risk averse you are, the larger the proportion of your portfolio that should be invested in safer assets like bonds and cash, while the more aggressive you are, the more you might allocate to stocks. Conclusion? Understanding the core concept of investment returns, risk, and portfolio structure is essential for making informed investment decisions. By balancing these factors and creating a diversified portfolio, you can work towards achieving your financial goals while managing risk effectively. If you have any questions or concerns about financial markets, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.